we thought the cash on cash was going to be really good. We thought the area was improving. It was kind of the path of progress. And if you look at YouTube videos and different, sort of statistics of the area, it is improving. We thought it would improve quicker, but we bought it in 2019. We learned a lesson that we bought it from a group that has like 3,000 units, and they knew more than we did about this type of business.
What's up, everyone? Welcome to another episode of The Remote Investor. I'm Michael Albom, and today I'm joined by my co-host,
Tom Schneider.
And today we've got a special guest in Geoff Stuhr, who's going to be talking to us about what it's like to be an investor, syndicator, and fund manager in the industrial space. So let's get into it. Geoff, what's going on, man? Good to see you again.
Awesome to be here. You're an awesome dude, man, and appreciate you having me on. It's an honor.
No, of course. Super happy that you took the time. So, Geoff, you and I actually got connected from a good mutual friend of ours who's doing some really cool things out in the tech world. But I'm super curious, and for all of our listeners, if you can give them a background, who are you, where you come from, and where they get into what it is that you're doing in real estate?
Absolutely. My name's Geoff Stuhr. I live in Milwaukee, Wisconsin. I was born and raised here. I've moved around a little bit, lived in Chicago for 5 years or so, lived out west in Nevada for a couple years. I've primarily been in sales, and I learned kind of at an early age that if I didn't take those commission checks and figure out something responsible to do with them, that that money sort of disappears, right? I find other ways to spend it on crap, and so I think I had one commission check kind of just dwindle away, and I'm like, oh my goodness, I can't keep doing that. And so as I got better and better at sales, I was in med device sales for a little bit, and then tech sales for over 8 years. And I have a good friend of mine that was buying primarily like duplexes, 2 to 4 unit properties in Milwaukee. And then he had subsequently then built a real estate investor focused brokerage and a property management company. And so back then I was just buying duplexes. I was kind of planning on, this was close to like 9 years ago, maybe give or take a little bit, maybe 10, closer to 10. I can't remember, but I was thinking, you know what, I've got a great gig in sales. I'm going to continue to buy, 1 or 2 of these properties a year. As my buddy's property management business grew, we got better and better at, renovating these properties and, adding value to them. And then, I kept buying more of them. They obviously, for a while I was self-managing. I think I had 8 units when I was self-managing them. And I was remote at the time. I was living in Chicago and, I guess not that remote, but I was managing them in Wisconsin, kind of having my dad help out with stuff like running over to the properties and stuff like that. And then, And then eventually to speed it up and move forward here,
Quick question before you speed it up. Man, that is jumping into the deep end. Remote, self-managing. Like, did your buddy kind of help you show you the ropes? Or, because there's a pretty big chasm to cross as an investor to one, make the decision to invest and then to self-manage. If you wouldn't mind kind of walking through that of, okay, what made you get comfortable, kind of mentorship. I'm curious to learn a little bit about that.
Yeah, it was kind of, I would say naivete at the time.
There's some value in being naive of, bravery. I don't know if the right word is.
Yeah, maybe bravery. I don't know. I just kind of thought, you know what? I had seen what he was doing, and he was making a lot of money and buying a lot of properties. And now today he owns over 400 units in his personal portfolio. And so he was really refining this system, right? And he was kind of helping me along the way. So I was, like I said, trying to manage them myself. It was a lot of shit to deal with, a lot of late nights, a lot of late drives back and forth from Chicago, and which is only an hour and a half, but just a lot of shit to deal with. And then I, eventually just outsourced the property management to him, was still remote, and then eventually moved back to Milwaukee. And, over time, we just, 5 years ago, a little bit over 5 years ago, we decided to pool money together from investors and sort of build this private equity syndication business. We did 13 or so syndications over the last 5 years, and then recently we just went even bigger, and we're raising $20 million for a fund for industrial assets in southeastern Wisconsin. So there's a lot to unpack there, but and happy to talk through all of that. But yeah, I would say I wouldn't have been as comfortable going into it. First of all, had I not been sort of naive, maybe brave, and second of all, if I didn't have somebody really mentoring me and holding my hand through a lot of that stuff.
Yeah, I love it. And Geoff, you've kind of embodied, I think, so much of the archetype of our listener base and audience base is working full-time job, making good income, wants to invest in real estate, does it. And then you did what I think so many people try to do is it sounds like you made that transition to go full-time. You've now since left sales, am I right?
Yeah. So I this year, at the beginning of this year, I went full-time in real estate. I knew that we had aspirations to start a fund. We looked at our portfolio from a business perspective across 13 properties and thought, it would actually, particularly in the industrial asset class, because there's not as much built-in diversification as there would be with like multifamily or self-storage. A lot of these buildings are like single tenant or 2 tenants, 3 tenants. So if it goes vacant, right, the investors that are in that property, and also for myself, we personally guarantee most of the loans that we have. So that's more of an issue than if we were to have a fund and have 10 buildings, and 7 of them or 8 of them are base hits, and one of them sucks and doesn't hit the pro forma, and then one of them's a home run grand slam. So that was the reason for the fund. But I can't even really remember where we were going with that.
Yeah, definitely. I mean, I think a lot of questions like one might have in someone starting a syndication fund, it's like, if you have this kind of like golden goose of a business, and I think I have like an idea of an answer. I'd love to hear it from you. Like, why take on outside capital? Like, versus, if you have this kind of, game plan, what's the value to you to bringing in outside capital versus kind of just, reaping the benefits within your own?
For sure. And it's something that I've thought about plenty of times, right? Because, so I left my job and have become even busier than I was when I was working. But the good news is I have a lot more freedom and flexibility to do it the way that I want to do it. And, there's not kind of corporate monotonous stuff that I have to do as much, and I love what I'm doing. But when you take on investor capital, effectively you're getting yourself another job, in a sense, right? Yeah, exactly. Now, you could say that the investors are limited partners, right? So they don't really have decision-making ability, but you have a fiduciary responsibility for them, and you have to be transparent, and your communication and reporting has to be done in a way that if you want to get more investors and more capital, you got to spend time on that. And so that stuff versus just me buying my own properties, I just felt like it was I'd met another partner. So there's 3 partners in the private equity side of the business called Smart Asset Capital. Me, my partner Adam, my partner Brock, and we have big goals, and we just kind of thought, do I want to do more of the 4-hour work week, Tim Ferriss model, not taking on any investors, or do we want to see if we can have some fun with it and see if we can build it big and maybe someday, turn into a REIT and go public on Wall Street or something like that. Like, I don't know if that would ever happen, but we made the decision that we had a lot of investor friends. I had a lot of people that wanted to invest with me in the tech world. And Adam had a lot of investor clients as a broker. And then we started to evaluate some of these bigger deals, and it just sort of made sense. But it's definitely, if I would tell people, the syndicator has gotten a really tainted word. There's a tainted perception on that, because a lot of people join
rebranded
courses.
portfolio manager. Yeah. Or, I don't know. But I feel
No, I hear you. And I don't think, syndication in general, right, is just pooling together money to buy some asset or business or something, right? And, you could take you get economies of scale. So you can, in a sense, the numbers can be better than if I was to just go buy a duplex. There's so many different strategies in real estate, but, it's definitely, it's not passive income, right? I work every day at it. Like I said, it doesn't always feel like work because I love real estate. I love having these conversations. I talk to anyone, even when I was in the W-2 corporate world, I spent many meetings where people were asking me about what I'm doing in real estate, and we would go about an hour long, and we didn't even talk about work. We talked about real estate. And so it's a passion of mine. I do love it. It's kind of the competitive side of things. Not that I care about like how many doors or how much AUM I have, assets under management. It's more just it's a challenge to try to build a company around this, and it's something that's exciting to us. And so I didn't necessarily want to be just passive and just get mailbox money. I wanted to build a business, and right now is kind of a harder part in our business because as we're scaling, right, we're growing very fast, and you got to hire people. There's different things like that. And, sometimes people don't want to manage people, and I get why. That's certainly a decision and a choice that someone shouldn't take lightly. But for us, it made sense. And hopefully as we build and grow this, down the road, I don't know if that's going to be, I still have a lot of energy and ambition. So if that's 10 years or 15 years, hopefully there's some point where we can hire enough people and really have the business be more on autopilot, where you're just making kind of thumbs up decisions, yes or no. And, you're raising money from a group that has known you for a long time, and, you're not necessarily grinding. But right now it's kind of grinding. So it's definitely not a decision to take lightly. If you have to decide between, in my opinion, what is your vision? What is your goal? I think honestly, and nothing against anybody that kind of wants to embody that 4-hour work week sort of mindset, that Tim Ferriss has. I just think I kind of would have been bored. And I enjoy the idea of building a company and going through the blood, sweat, and tears that it takes. So that would be how I would answer that.
That's great, Geoff. And I'm just curious too, like, I want to hear about the grind. Let's pull back the curtain a little bit and find out what it is, because I think so many investors, again, kind of start off like yourself. They have a job, they start investing in 1s, 2s, 3s, 4s, small multifamily, whatever it is. And then I've seen a lot of people go into the syndication space, and we're going to get into why they've probably gotten such a bad rap in a little bit. But it seems like, I think so many people get this idea in their head of, I'll put together $1 million, $5 million, $10 million, whatever the fund is, go buy a couple properties and then sit back and cash checks. But like, it doesn't seem to be the case for you. So what's going on? Like, how does that all work?
Yeah, no, there's kind of gurus and books out there that have sort of painted this in a different way than it actually is. And like I said, when you start a private equity company or you start taking investor capital, it's really a business, and you have to think about asset management. You have to much more than you would if it was just your own portfolio of 5 properties or so. Because you're accountable to those investors, right? And you're trying to, if you want to grow the business, right, and you want to get investors and keep investors, you need to really be trying to meet the pro forma and have it be as predictable of returns as possible. And so, there's things that you have to really get on, whether that's from a leasing perspective, whether that's value add renovations that you could put off if it was your own property, but it's like we've got a schedule to hit, right? So there's a lot of that stuff, asset management, just KPI tracking, investor raising capital. So once you have a fund, or even if you're syndicating a deal, right, but you've got a deal under contract, now I've got 60 days to put together this capital and get that in the door. That's effectively a sales job, and I do very similar work as what I did when I was in the W-2 world in sales. Right now I'm selling investment opportunities essentially, or trying to, find a win-win solution, somebody that's looking to deploy capital and place that money to work. We have an opportunity for them to do that. But, as for right now, the grind is, and I could talk about the grind at each level. When I had one duplex, there was things that were like, oh my God, I've got this burning fire going on. I had one property one time that, the sewage system backed up and there was, nasty stuff everywhere in the basement. People couldn't get to their, and it was like New Year's Eve. So that
Of course it was.
Stressful. Yeah. And, at each level that I've been at, there's been, these moments where you're like, oh my God, I can't even do this anymore. Like, this is brutal. And then you kind of fight through those hurdles and that adversity, and then things get easier. But, the grind right now is just that we're seeing more deals in the last 2 months than we've seen in the first 6 months of the year. I think that's twofold, because I think the buyer and seller staring match where interest rates doubling and, in a year and a half kind of created this staring match where sellers were like, well, shit, I could have just sold my property in 2021 for this. But now with interest rates being double what they were, I'm not going to get that price anymore. I think there's more of a realization that way. And the stuff that we're buying too, a lot of, whether that was syndicators or whoever, inexperienced operators or whatever the scenario, they took out, shorter term debt, and now that needs to be refinanced. So, they have to either refinance at a higher rate. If they didn't add the value to the property and the net operating income, they're not going to be able to support the debt anymore. And then they've got to look to sell. And so I think that's one thing. And then the other thing is we've just been very, very active with the brokerage community, saying that, hey, we're raising $20 million. We've already got 5 million raised. We are, we have to place this capital. We need deals. And so that was an interesting sort of flip where I think, in commercial real estate, we were not really on the, we had a couple brokers that we were in their, top 5 list of buyers that they would send us stuff. But I think we've been so active with the brokerage community. We've proven that we can close on these deals and that we have a solid thesis. We literally show them the money that we have raised. And I'm like, I'm not kidding, man. Look at my screen. What deal do you have for us? And not to say that we do bad deals. We've got a board of directors that has governance and oversight over us. We have a very stringent investment committee and deal committee process to say no to deals. We say no to a lot of them, but I just think that having the fund has opened up more opportunities for us. And so the more opportunities we have, then we just closed 2 deals last month. I've got 2 deals that are closing in mid-August, and then I got 2 more deals that are that we're negotiating. We're in the LOI phase, and if so that means I have to keep having investor conversations. I have to keep raising money and getting more people into the fund, and that's kind of the grind for me right now. Not to mention just I also oversee leasing for our portfolio, and I don't necessarily do the leasing. I work with leasing brokers, but there's a lot of things that need to happen to get it, get the space ready to be leased and presented as best as possible. New paint, whatever it might be, new lighting, more power, more air, parking, whatever.
Are you guys doing mainly duplexes, or I'd love to talk about sort of those details of underwriting and what type of assets and all that good stuff.
Yeah, so I'll walk you through the start of it. So we started with duplexes, and that was when I was building out my own portfolio, and I still own a lot of those. But we started with small multifamily, and then when we first did a syndication, first we did a joint venture. It was me, my partner Adam, and then my dad. And I think my dad's been to the property once or twice. But we bought just a third. It's been a great deal for him without having to really do any work on it. But
are these one-off acquisitions of duplexes, or any sort of little portfolios of duplexes, or?
That was just one-off acquisitions.
Yep.
And then we bought a 34-unit apartment building, and that was just that wasn't no syndication or anything on that. That was just 3 guys partnering together and putting up a third of the money and going to buy this thing.
And this is using your buddy's property management company to do it as well?
Correct. Yep.
lease
So
and
everything is
manage out?
managed by the property management company. And then after we sort of proved out the model that we can buy and operate a 34 unit building, that's when we decided to open up the opportunity to investor capital. We bought an 89 unit apartment building in a syndication model. And then from here, and my investors, I don't think love this, but we spent, a couple years buying a number of different asset classes. The thing that we would look at first was, do we like the location? And is there some value add potential? And, does it cash flow well? And then that was basically it. But we bought a strip mall. We bought some office buildings, which thankfully we got out of that. And then we bought a self-storage facility, and then we stumbled into industrial. And we bought some more multifamily in between then too. But over the last 2 years, we started to focus. We stumbled into an industrial deal. It went really well for us, and we started to kind of double click on that in this market.
I'd love specifically around like industrial. Like, are you talking about like a manufacturing plant, or what do you mean by that? Kind of in more like concrete terms.
The first one was what's considered small bay flex industrial. So it's like 4 industrial bays with a dock door and a small little office space. It might be a landscaper in there or an auto mechanic or something like that. Just small businesses, and that's a really good asset class or sub asset class to be in right now. And we still do look for properties like that. But to your point, since then we bought 5 or 6 industrial buildings, and that's broken up between, we've got, just general warehouse, manufacturing. We got a manufacturing facility, with a ton of power in there. We've got a distribution sort of facility, but mainly, that's basically it. And the thesis of our fund is Class B industrial real estate. That is, so basically not the stuff that you're seeing built on the side of the freeways that are like an Amazon or FedEx massive mega complex, right? Like obviously not that stuff, but it's stuff that's basically built in existing industrial parks, close to rail, close, freeways, ports, and we're right on the lake here in Milwaukee. And so the location of it's got to be pretty strategic. And then what we're buying now is, so it's existing infill, like built within the existing infrastructure. And usually what we're buying is 3x lower than what it would cost to replace it today. There's still a huge need. If you look at industrial vacancy across the board, and you don't really double click into the different types, sometimes it doesn't look as good. But if you narrow that down to like 20,000 to 100,000 square feet or 150,000 square feet, the vacancy is really, really low. So like Waukesha, Wisconsin, which is where our headquarters is, it's in between Milwaukee and Madison. The industrial vacancy rate I just looked at is like 0.8%.
This is all small, medium business you guys are supporting for. Yeah. Basically that whole niche.
Exactly.
Yeah.
Exactly. And a lot of times these buildings are owned by the business, and for whatever reason they'll want to do sale leaseback deals. So they will, because they know that, okay, I own this building, it's $5 million. If I sell it, I can take that capital and inject it back into my business to grow my business, versus refinancing at, 7 or 8%, and then having to pay that. I can do these sale leaseback deals, which are kind of win-win for the buyer and the seller.
Totally. That's so interesting. Like these motions are like, I'm very familiar with like SFR and all that stuff, but it's like you're applying these same type motions. Kind of a philosophical question for you. Like I would think like as a business, you're building out like proficiencies and, these larger kind of like apartment complexes. And man, it seems like a very different sales motion and like process in industrial. Like how did you guys like get to the point where it's like, you guys are making some pretty big bets in residential and, making the switch to strip malls, industrial, all this other stuff? I love it. I mean, I can see though, there being some good kind of philosophical discussion amongst the founders of trying these other sort of assets when you're like building these competencies in these other kind of sectors, right? So I'm curious about that sort of problem.
Yeah, I would say it's not all that different, right? You just try to figure out what the value add levers are to like renovate the properties. And so it'd be like buying a B class apartment building that's got a lot of deferred maintenance but it's in a great area, and you come in, you buy it, you strategically figure out how you're going to renovate each of the units, new landscaping, new kind of amenities, if you can figure out which amenities to put in there, and then new signage and new branding and new marketing efforts. That's sort of the game in the multifamily world. And it's very similar in industrial, right? Like I think I was saying this before, but like a fresh coat of white paint, like ultra white paint on an industrial building makes it look 3 times the size. And so, we're trying to find these industrial buildings where maybe not everything. I mean, some of these buildings might have 10 years left on the lease, and some of them might have 1 or 2, right? And those 1 or 2, they're at a very low rent comparatively to the market. And we're going to go in there, buy it, put new signage up, new, like redo the parking lot, new paint, new dock cushions, like, things to, maybe more power, more air, if there's no AC, like stuff like that. And, refresh the office space or their conference room or whatever. And sort of, and it's not slapping lipstick on a pig. It's basically taking a older, outdated, 1980s building and trying to make it look as nice as possible, and then going out to the market to lease it out to somebody, that, and having it look a lot nicer than it currently does. And then, having them pay, the market rent. So mark to market. And, it's very similar in that you just come up with a value add strategy. You have a capital expenditure forecast, and you figure out what is going to allow us to achieve the market rents, for this property. Right. And I think you have to get comfortable with, longer vacancy periods, right? That's one thing so leasing is crucial. It's a lot harder to lease up an industrial space than it is to lease up an apartment. But the thing is, when you do get them in, instead of a year lease on gross terms, it's usually, 3, 5, 7, 10-year lease on triple net. And when I figured out what a triple net was, I was like, oh my God. I always say God bless.
Well, I haven't been doing this the whole time.
Yeah. Like in single family rentals and multifamily rentals, you've got the tenants, the termites, the toilets. With a triple net lease, you're essentially passing those costs, taxes, insurance, maintenance, all back onto the tenant. And so if you think about like inflation and all of these costs are going up, taxes, insurance, maintenance, labor, that stuff is all going up. If you're able to negotiate a triple net lease at a favorable rate and push those costs back onto the tenant, it can be really, really good for your returns and insulate our investment from inflation of that type of stuff. And then the other thing is they're longer term leases. If it's a manufacturing building, it's really hard to move all that stuff. So you do due diligence on the tenant, make sure that they're solvent and that they have a solid business model and that they have maybe a strategic reason to be located in that area. Even if they sign a 5-year lease, they might have 2 5-year extensions, and, they're going to be in there for a long time with rent escalators every year at 3%. And so, it's not something that you get comfortable with like overnight, right? We did one deal, and then we kind of did another deal, and then we're like, okay, that was good too. And then we did another deal, and it was like, all right, we're getting comfortable with it. We learn more and more on every single deal. And that's the same thing as whatever type of real estate investing you're doing.
That's so great, Geoff. I'm curious, you've now kind of run the gambit in terms of deal flow and asset classes, starting with the duplexes, the 1s and 2s, now all the way up to industrial flex space. So knowing what you know now, 2 questions. A, would you have gotten started in commercial sooner? Do you wish you had gotten started sooner? And 2, if you do think that, what tools, tips, tricks, resources would you point your past self to go be equipped to do so?
Yeah, so a little bit multifaceted of an answer, I think. I don't know if we would have been comfortable doing commercial real estate like this earlier without having the experience that we had already had in already adding value to these properties. And then we could clearly sort of see the translation of, well, we did it with this property. How do we do it with this property? And so I don't think we necessarily, I think the way that we started, the only thing I would say is I wish I would have bought more real estate along the way.
Yeah.
You know,
you're in good company.
Yeah, exactly. Right. So and I wouldn't have sold properties that I really liked, but I did sell a few, especially around COVID. I thought, I told my
peaked out.
My girlfriend at the time, I'm like, you're marrying a damn genius, like I'm offloading these properties. I'm going to buy them back at pennies on the dollar. And then it just continued to go up. But, so I wish I would have bought more along the way, and I wish I wouldn't have sold certain properties. And I just look at single family or multifamily or self-storage or mobile home parks or short-term rentals. That's just one avenue of real estate. And to do that, you've got to figure out a way to learn that game, whether that's through reading, through podcasts like this. I listen to a ton of podcasts. Now I listen to a lot of industrial real estate podcasts. Chad Griffiths has a great one. And, but at the time when I was, learning more about real estate, I was on Bigger Pockets every day. I was listening to their podcasts all the time, watching YouTube videos, reading books. You might consider joining some of those masterminds. Be careful if it's, kind of more of the guru route, but,
I will tell you the secret sauce.
Yeah, exactly. And then finding a mentor, somebody that that's having success in that space. And that's something that we've done along the way, every time. So I joined, like I said, there's this group called Industrial Insiders, and it's not a guru thing by any means. I think it's like $200 a year or something. And you just get access to, this sort of community of people that are looking to buy industrial deals. And they might be in different markets, or maybe they're in markets that are close. And so you get on a call with them every other week on Friday. There's not one this week. So, and then you're able to, you get kind of introduced in a Slack channel, and you can trade ideas with that. I think that stuff like that can be very, very beneficial because you're meeting people that are doing the same thing. And I would do that whether I was flipping or wholesaling and I haven't done any wholesaling or flips, but, whatever sort of speaks to you the most and whatever you believe in the thesis the most, I would then try to get as educated as possible. And then don't be afraid to pull the trigger, right? Like, there's going to be headaches. There's going to be bullshit that comes up every single time. But if you want it bad enough, you'll push through that.
Yeah. No, I think that's great. It's interesting. I'm curious, like from a price point perspective, if someone believes in the thesis and develops their own thesis that yes, commercial real estate is the place to be for me. I think everybody can wrap their head around what single families cost, what duplexes cost. I blew some people's mind when I told them I bought a 6-unit building for $90,000 out in Cincinnati, Ohio. They're like, "What? That's cheaper than a single family." So like this stuff does exist, and just because it sounds bigger doesn't necessarily mean it costs more. So from what you've seen, are there industrial spaces and industrial assets that do not cost $20 million, like the size of the fund you're trying to put together?
Yeah. Well, with the fund, we're trying to raise $20 million and go buy $70 to $80 million worth of real estate. But, and our sort of model is to try to buy things that are too big sort of for the individual investor, unless, especially even like a doctor, somebody that would have the cash to put up on their own. They would need to really have a good understanding around how they're going to add value to these properties and how they're going to run it, even unless it's just like a coupon clipper, triple net lease deal, and that's not going to be priced cheap at all, right? So, we try to buy things that are too small or too, maybe difficult for the individual investor, but too big for the individual investor and too small for like the institutions or the bigger groups. And so, yeah, our first industrial deal we bought for $550. That was four different industrial spaces. We sold it for like close to $900. I don't know if I see like $90,000 properties. I'm sure they're out there. Those are probably heavy, renovation type projects. But but it isn't as, not every property out there is a few $1,000,000. And so the way I would say to get started with commercial is you probably have to, depending on how much capital you have, right? You've got to learn the space, and then you probably got to figure out, people to partner with, to pool together money and go buy some of these bigger buildings.
Geoff, I'd love to hear some hard lessons, both on the investor, relations side, and then also some hard-earned lessons on the actual in working in industrial kind of commercial. So kind of both different sides, like as the syndicator, private equity manager, and then as the operator.
I'll tell you a couple hard lessons. One, we bought the first 89-unit apartment building we bought. There's a YouTube video out there on it. We call it the 89-unit apartment from hell. We bought that because we thought the cash on cash was going to be really good. We thought the area was improving. It was kind of the path of progress. And if you look at YouTube videos and different, sort of statistics of the area, it is improving. We thought it would improve quicker, but we bought it in 2019. And, we learned a lesson that we bought it from a group that has like 3,000 units, and they knew more than we did about this type of business. And we were getting a agency debt, a Fannie Mae loan on it. And there's a term called 90 for 90 that they're not going to loan on the property unless it's 90% occupied for 90 days leading up to closing. And so what happens sometimes is that the existing owner will just fill it with bodies, you know? So I learned the lesson of physical occupancy versus economic occupancy. So we had a lot of people in there that weren't paying, and, it's kind of a rough area. And, so we really struggled. We had to evict a lot of tenants, and they didn't leave the place like you or I would. They beat the hell out of it. We had to do this full rebranding, but really we blew through our budget very quickly that first year, and then COVID hit. And then it was a struggle to get rent. We didn't lose a dime of investor money on it, but we ended up selling it and, giving a small return back to investors and just getting out of the deal. So that was a tough one. And that also, kind of leads into, capital raising. When you raise money for something like that and it doesn't go well, and that was your kind of, a lot of them were your initial like power base of network. They're like, I don't know if you guys know what you're doing, so that overcoming that was challenging. And luckily we've been able to have a lot of good deals since then. So then if I move forward, I've got a lot of these we could talk. We'd have to do a whole other show.
I'm into it, man.
We'll do a whole other episode about lessons learned.
Yeah. I'd say other lessons learned, and not to get too granular on it, would be, you pay for what you get, right? So if you have somebody that is an inspector that is the cheapest cost, or whatever it is, right? Your attorney, your inspector for sure, the cheapest is going to get you the worst work done, and then things are going to get missed, and that's going to create more work and more money and time down the road. So now we try to work with the best of the best that we possibly can and be as thorough as possible in any of those things. And so that was a naive and inexperienced move starting out. I've got a deal right now that it was sort of the thesis for the fund, that we bought this deal, and it's a 82,000 square foot industrial building it's kind of a wonky layout. It was kind of customized and configured specifically for the tenant that was in there. The tenant got bought. We did a sale leaseback. The tenant got bought, and the private equity company decided to move away from that and buy themselves out of the lease. And so we thought, great, we'll just take the buyout. It was hundreds of thousands of dollars, and we'll just put a new tenant in there, and it's gonna be great. And it's been very hard to get a new tenant in that space, and there's certain things that we didn't know about enough. Now we do have 3 short-term tenants in the space that are like covering it, breaking it even, and but we're actively marketing it for sale or lease, and that was something that, looking back on it now, we wouldn't buy that deal, even though we bought it at like a 10.6 cap rate. So we did have it under contract to be, so we bought it for 3.2. We had it under contract to be sold for 4.9. It was going to be a huge home run. Plus we just got paid a lot of money for breaking the lease. However, we just, the deal fell through because it's zoned for light manufacturing, not heavy manufacturing. So we're trying to work on that, see if there's an angle on that there to change the zoning. But, it's really meant for heavy manufacturing. It's got a ton of power. It's not the highest clear heights. The layout of the building kind of sucks. And really what we look at now when we buy these industrial buildings is the ability to partition the spaces off and subdivide things to make it easily useful for multiple tenants in there, which right now it's not. So the one thing that we did, is we bought it right. Thankfully, if we had to fire sell it, we could do that all day at the price that we bought it for, or even more than that, because someone would find use in that. I think but those are things you just really don't know enough until you get into it, because so me telling the story is basically when you think you have a really good deal, you really should try to find people around you that will beat the hell out of it, like beat it up,
poke
like
holes
try
in it.
to tell me, poke holes in it. Tell me what. So now we have an investment committee meeting every week, and we do a bigger one on a monthly basis. We have a board of directors. Our acquisitions guy will come in and basically present these deals. We read the briefs beforehand, and we basically come to the meeting trying to tell them why that deal sucks or why there's risk and why we're not going to do that. We didn't have those processes set up back then, and we had to learn the hard way, and some sleepless nights. I mean, with the 89 unit apartment building, I'm like, well, shit, this business is done. Luckily, it was a non-recourse loan, but we didn't want to lose any investors' money and lose all that credibility and everything. I thought our business is done before we even got started. Like, I better figure something out in tech here. I still got a small portfolio of 2 to 4 unit deals, but yeah, those are some lessons that I would say that people should, hopefully they can learn from my mistakes too.
I love that, bringing in smart people to pick holes. I know we're getting closer on time. I have one last kind of operational, like self-serving question. I like industrial seems so interesting, and this conversation has really like turned me on to it. So from like a market targeting kind of perspective, so you guys are in that Midwest area. Do you find that there's enough like available sort of like deal flow? And if yes or no, are there other markets that you guys are looking at, in the US to kind of fill this appetite of investor demand?
Yeah, so from a macro perspective, industrial, I think, is going to be hot for a while, right?
Yeah.
There's a onshoring, reshoring, nearshoring movement where companies are bringing operations back closer to the biggest consumer in the world, the U.S. economy. And a lot of that is benefiting from the Midwest. That's kind of centrally located, low cost of living, low cost of labor for companies placing like warehouses or distribution facilities or manufacturing facilities there. I would say so. We are, Milwaukee used to be called the machine shop of the world back in the day. So there's a ton of manufacturing jobs here. There's a ton of the infrastructure built around that. So we kind of lucked into that, and we have really good relationships with the industrial brokerage community here. So we plan to, this will be our headquarters. We plan to stay here, and the deal flow is certainly enough for us right now. If we continue to grow and we have these bigger aspirations, we would have to go to other markets. I would prefer to stay in the Midwest, and even, there's a group, Plymouth REIT, that calls it the Golden Triangle, which is kind of Milwaukee down to Texas, down to the Southeast, and they buy only industrial real estate just like us. That's where, so many of these types of jobs are located across the country. There's another guy called Peter Zion, who's like I'm not sure if you know him or not, but he's like, like he's really big into, he has really almost nothing to do with like industrial real estate, but he, has predictions and forecasts for what's going on.
An economist. Yeah.
An economist. Yes,
Yeah.
exactly. And so, he's predicting that there's going to be a ton of industrial warehouse space that's needed across the border. It's cheaper to build stuff in Mexico than it is in China, even, and it has been for a while. So there's a lot of building happening near the border in Mexico that'll from a nearshoring perspective will need to be assembled or whatever over across the border in the States. So San Antonio is a great market. I think that will be very hot. Now, I'm not really in the business of like trying to predict the future. I believe in the, with the supply chain disruptions of COVID, companies trying to bring their operations back closer to the consumer, companies trying to, we got a lot of companies that are leaving Illinois and coming across the border to Wisconsin. It's just cheaper labor and cheaper cost of doing business. I believe in that, and then I just try to look for deals that we think cash flow well, are in great areas, and will have some opportunity and meat on the bone for us to improve the properties. But like I was saying, so eventually someday we're gonna always have this, like the nucleus be in southeastern Wisconsin, because we like a lot of the things about it. It's a very linear market with great cash flow. But we will go to other places. I like Columbus, Ohio a lot, not just for industrial, but also for other asset classes in real estate, and down around the border in states that are making it easy for businesses to or people to buy real estate in. I think those markets will do really well.
I love that thesis. It's one of those, like, you hear it and it's obvious, but I don't know, like I hadn't really thought too much about it. But anyways,
we didn't come to that conclusion.
No, very much picking up what you were putting down. Go ahead, Michael.
Jeff, I'm curious, like if I put on my LP investor hat, if I'm going to go put money in someone's syndication, I mean, by your own admission, you shared with us, you kind of missed the mark with that 89 unit. And we're hearing stories of so many investors and so many syndications going belly up, sideways. You guys did an amazing job by not losing any investor money. But what do you say to an investor that has given you money, that has trusted you to be a steward of their money and grow their capital, and then you come back and you're like, oh man, we missed. Oops.
Yeah.
How do you earn their dollar? How do you earn their trust back?
Yeah, the number one thing is, the thing that helped us there is the three partners took out a line of credit and didn't ask for any sort of money from them, no capital call. We just kind of said, look, we're going to go down swinging and, make sure that we get this thing right. Now, investors don't like, and the thing that I would say is you've got to have very transparent communication. Like, okay, this is what the numbers are looking like on a quarterly basis, and here's why. And, we didn't anticipate these three things. Like with that 89 unit apartment building, we didn't anticipate we were going to have to evict 40% of the building in the first year. And then we definitely didn't anticipate COVID was going to be something. And, so it is what it is. They understood that. So I think, not that you get a pass on that, but there was clear reasons for things that we didn't think about. We just basically, you try to be as transparent as possible, communicate. There's a saying that, we basically try to, walk good news out the door, but we run bad news out the door. We want to let people know and be as transparent as possible right away. And, so I think that the ability to communicate transparently, honestly, and have legit reasons for, why things are the way that they are will help you save face as a sponsor of a deal. And that's the same thing in business. And I've been through a lot of quarterly business reviews, right? Within my sales background, and you got to stand up in front of your whole team and your vice president and the VPs above them and all these, people, and you've got to explain what, the good, the bad, and the ugly. And so I've had a lot of experience. I've had a lot of success doing that. And I've had a lot of experience explaining why certain quarters aren't as good as other ones. And, it's just that mindset of transparency. And I've said from day one, like, if I'm going to take investor capital, I don't want to go to jail. You can actually go to jail for lying to investors and misrepresenting things and doing other things with the capital that you're saying you're going to do. And that's a non-negotiable for me. We are, we try to have the absolute gold standard for ethics and try to just treat people the way that we would want to be treated. I've invested as an LP before too. I've invested as an LP in a deal that didn't go well. I almost had to sue someone, which is crazy. That's a story for a different deal. But their communication and reporting was terrible, and so we try to just if investors can. It's a risk no matter what, right? Like going into business is a risk.
No doubt.
So there's things that happen that are good and bad, and there's things that can be out of your control. It's how do you handle the things that are out of your control, and are you putting your investors' capital first, right? So we took on, again, when this thing, I didn't make a dime from that deal, not one dime, and I had 3 years of a lot of sleepless nights and headaches. And then we also took on a significant line of credit, personally guaranteed, to make sure that we didn't have to, go ask for investor money on that. And I think a lot of the syndicators, that went through the guru programs that thought that it was normal when interest rates were so low, and they were encouraged to buy everything that they could, and they didn't really have a handle on, it's hard to run a 100-unit apartment building, and I wouldn't want anybody to, sugarcoat it at all. It's very, very hard, and even in a good area, if you haven't done it before and you've only done, a couple units here and there, like it's a whole different animal to manage that type of scale. So you have to figure out how to get the systems and processes in place, and I think a lot of people just, followed a program and they went and raised money from friends and family, and they basically didn't have the experience or just the experience to
execution
to be able to execute on the business plan, and then if you marry that up with the wrong kind of debt, luckily our debt
spiral.
was we had a 10-year loan that we probably should have sold it assumable, but it was in the threes. And, that saved us too. But, it was just, we sold it to somebody that buys a lot of properties in that area, and they have like thousands of units in that area. And they have it down pat. And now you drive by it almost looks like a different building. I'm like, man, I worked on this for 3 years and it sucked. And now this guy just whipped it into shape. So I know I rambled a bit there.
I think it's a good kind of evolution of discussion, and I think one of my takeaways is, oh man, that triple net lease is a very soft pillow to sleep on at night, versus some of the overhead you get in residential stuff. So yes.
God bless the triple net lease.
Yeah. No doubt. Well, Geoff, man, this was a ton of fun. Thank you a lot for taking the time and chatting with us. I'm curious, for everyone listening who wants to learn more about you, who is interested in your fund, where can they find out more information?
Yeah. So I'm basically, my name it's kind of spelled funky, but it'll be in the show notes, obviously, or whatever. But it's Geoff with a G, so GeoffStuhr. LinkedIn is the platform that I'm the most active on. So if you want to connect with me on there, I'm trying to post daily and schedule posts for, weeks out. So I post a lot on LinkedIn just about the trials and tribulations and the stuff that is going well and the stuff that isn't going so well and the things that I learned. So that would be the best place, and smartassetcapital.com. That you can find out more about our company there. We have an active fund that is focused on Class B industrial real estate, and so raising $20 million right now. We've got multiple deals under contract, and I've closed on a number of deals already in the fund. So anybody that would be interested, and also I tell people this too, I'm probably too giving with my time, but I genuinely want to help people. If someone's trying to wrap their heads around something, I'll get on a call with somebody, no matter what. And people have helped me. So I try to, help people when I can. So if someone wants to reach out and maybe they aren't even in a position to invest, I'm happy to help them figure out, how I might do something given all the mistakes I've made.
No, that's great, man. Well, I know they sure appreciate it. And is that for your fund? Is that accredited investors only, or you take non-accredited as well?
So up until the fund, they were all 506B deals that were, essentially they didn't have to be accredited investors, but the fund is 506C. So it's for accredited investors only. We can shout it from the rooftops and advertise and all that stuff. And so, yeah, you do have to be an accredited investor to invest in the fund. But that's a strategic decision that we made because we're really trying to grow and we're trying to build it so that we can be, institutional quality, down the road.
Sweet. Well, we will post all that in the show notes. Man, Geoff, thank you again for taking the time, man. And yeah, dropping this knowledge bomb on Tom and I can see the wheels turning kind of in both our minds.
The pleasure's all mine, guys. And I'd love to come back sometime. And also I have a podcast too. So would love to have you guys on. I don't know. I think I might've connected you guys, but I'll work on that again, but it would be great to have you guys on as well. And I appreciate you having me.
Awesome. Thanks,
What's
Geoff.
it called, Geoff?
It's called Winning Wealth. And so it's not necessarily I probably should have mentioned this while we were recording. I'm not sure if we still are, but
we're still doing it.
Okay, cool. Yeah. So Winning Wealth, it's the premise of the podcast is wealth, health, and happiness. And so it's not just real estate related. We have a lot of real estate people on, but it's we'll interview people about different things in fitness, or I'm trying to get like a Buddhist to come on and talk about simplifying your life and having a super happy lifestyle. So we always ask our guests about, tips that they have. One tip for building wealth, one tip for, living a healthy lifestyle, and one tip for, living a happy lifestyle. And so that's the premise of it. Again, we talk to real estate people 75% of the time probably, but that's just because we're in that business. And I truly believe it's a phenomenal way to build wealth. And over time, it's not a get rich quick thing. I've been doing this for 10 years. I don't consider myself like super wealthy or anything like that, but it's changed my life for sure. It's given me the opportunity to not work for someone else, other than my great investors. But, it's a great way to build wealth. So that's why it's featured on our show so often.
I dig it, man. We will definitely post that in the show notes as well. Geoff, it's been a pleasure, man. We will catch you on the next one, dude.
Looking forward to it, buddy.
Be good, man.
You too.
All right, everyone. That was our episode with Geoff. Thanks, everyone, for hanging out with us. Happy investing.